When you get the Federal Bank of New York refusing to return the Bundesbank's gold and eventually agreeing to return a small portion of it and taking 7 years to do it, you begin to ask yourself, what have they been doing with that gold? When the long bond breaks that sort of 5.1-ish, 5.2-ish level, I mean, we're heading to 20%. The US government will not be able to fund its debt, and it will try and rescue the economy because that's its tax base. So how does it do that? That's QE to infinity. When the idiots in the investment world treat gold like an investment, it does create an enormous opportunity for any Johnny-come-lately to get into gold and get out of collapsing credit. This is the most expensive market, equity market we have seen in the financial era. Credit has been fueling this market. Just look at the FINRA numbers, which shows broker loans. That has gone up from about 250 billion in 2008-9. Currently, we're looking at over 1.2 trillion.
A lot of people say scared money doesn't make any money, right? And if you're just putting all your excess capital into gold, that seems like a pretty scared move.
These are very dangerous times, Aaron. They really are. And investors don't understand it.
Hey everyone, this podcast is not investment advice, and I'm certainly not a financial advisor. Just a guy who spends too much time reading about markets. Before investing, do your own research, talk to a licensed advisor, and remember, risk is part of the game.
So there are really two camps in the precious metals space right now. One camp says, relax, this is just a pullback. Gold and silver are going way higher. Of course, we know the debt is too big, currencies are weak, and governments are addicted to spending. Maybe they're right. Maybe that camp is right. Maybe gold is going a lot higher. But there's also another camp, and they're not crazy either. Gold went to $5,600 earlier this year. Now it's around $4,300. Silver hit 120. Now it's around 67. And when you take that kind of a beating, especially if you came in late, in an asset that you bought for protection, I think you start asking the question, was I early or was I wrong? Today I'm joined by Alasdair Macleod. Alasdair began his career on the London Stock Exchange in the 1970s and spent decades in banking and investment management. His overall outlook is simple, and I agree with it. Unsound money is one of the most destructive forces in modern life. To Alasdair, gold is not a trade. It's a way out. And today, gold and silver prices are telling investors one story. Deficits, currency debasement, fragile banks, and governments are telling another. One of them is lying. I think I know which one. But I think investors are wondering if they should believe the price action or stick to the reason they bought these precious metals in the first place. Alasdair, welcome to the pod.
Thank you for having me, Aaron.
So, my pleasure. So I want to start kind of with the hard part. So I'm long gold and silver. I've been for well over a decade, and I understand the long-term thesis. But the near-term setup does not look too bullish to me right now. Rates are a big concern. Capital is chasing things like AI, robotics, data centers, and so forth. From a fundamental perspective, not a technical one, do you see any near-term catalysts for gold?
Well, I think the first thing I would say is that the approach you've outlined is one of an investor. That's a completely wrong approach. An investor accounts in the currency, if you like, that he accounts in. So in your case, it would be dollars. And the point about investment is you try and maximize your return in dollars. But that's not really what gold is about. Gold is money. It's not an investment. Silver also is money, but there is the addition there of, if you like, industrial use. So that's a more complex situation, which I'm sure we'll come to. But the point about gold is it is legal money. It is legal money in everybody's common law. And you don't expect it to go up. You shouldn't, really. because money is stable by definition. For it to work as money, it has to be stable in terms of its purchasing power. What we're looking at is a decline in the value of fiat currencies, and particularly the dollar. That decline is basically accelerating. Now, nothing goes down in a straight line, and the value of dollar credit, if you like, follows that rule just the same as anything else. And I think that, we've got a very good example, I think, currently of the sort of cross currents that go through. The investment community look at the inflationary consequences of the war against Iran, and they begin to worry about it. And they think, well, in that case, we're not going to get a cut in interest rates. Therefore, the cost of holding gold is going to go up. So that's bad for the gold price. Now, that's the investment thesis. But the monetary thesis is really very, very simple. And that is this Gulf War is a continuing problem. Prices of things were already going down, are going up, reflecting a falling purchasing power of the dollar. That is accelerating. The fact that interest rates are likely to rise, but more specifically, bond yields are likely to rise. And when they break, when the long bond breaks that sort of 5.1-ish, 5.2-ish level, we're heading to 20%. So what's that telling us? Do you as an investor say, well, that makes gold impossible to hold? Or do you maybe just look a little bit at history and say, well, in the 1970s, at the beginning of the 70s, gold was $35 an ounce, and the Fed funds rate was around about, it varied between, say, 3 and 5%. At the end of the decade, and more particularly in 1981, gold was $850, and the Fed funds rate was damn near 20%. So, which is right? Well, the answer basically is that it's the dollar that is going down. The dollar is in difficulties, huge, great difficulties. The US government will not be able to fund its debt. The US government will find that it's got a huge, great slump on its hands, and it will try and rescue the economy because that's its tax base. So how does it do that? That's QE to infinity. What does that do to the value, the purchasing power of the dollar? Well, it knocks it sideways. It goes down and down and down. What happens then to the gold-dollar relationship? Well, the example is quite simple. Gold doesn't change. It's the dollar going down. So in essence, this is not an investment argument. It's an argument about getting into safety. And when the idiots in the investment world treat gold like an investment, it does create an enormous opportunity for any Johnny-come-lately to get into gold and get out of collapsing credit. It's as simple as that, Aaron.
That's an interesting take. You mentioned 20. You think rates are eventually going to make their way up to 20% long term?
I don't know where it'll stop. The fact of the matter is that the US is in a debt trap. It has debt to GDP, I'm told, about 125%. The cost of, if you like, servicing the debt, not that it's ever serviced, is rising and rising very, very substantially. On top of that, the problem from the debt trap point of view is that you need to have tax revenue growing at least as fast as the debt. Now, if you get a slump in the economy, then your tax revenue is going to go backwards. It's not going to be growing. So that, if you like, brings huge, great risk into the value, if you like, of bonds, particularly along the yield curve. And you have to ask yourself, well, under these circumstances, at what rate of interest is a foreigner, let us say, or even a domestic US institution or a hedge fund prepared to buy? What sort of yield is he prepared to buy US Treasury debt on? And the problem here is the higher the yield goes, the worse the position of the US Treasury. So that is the debt trap. And there is no escaping from it. I mean, last time we hit this was, again, I go back to 1981 when Paul Volcker was chairman of the Fed. I think I'm right in saying that the debt to GDP was in the order of about 40%, maybe 35%, something like that.
Mm-hmm.
Now, Volcker pushed up the Fed funds rate up to, I think it was just over 19%. At that level, you could see that was enough to stabilize the dollar, and therefore you sold gold and bought dollars. But just imagine what happens now if we hit that rate with a debt to GDP of 125%, a contracting economy, and prices going haywire basically because the Fed has got no option but to print, if you like, so that people can afford to buy the energy, buy this, buy that, and all the rest of it. I mean, this is a debt trap. Now, I sort of suggested 20%. I don't know. I mean, it could go to 40%. But we're looking at the end of a fiat currency era. And under those circumstances, no percentage is going to work for investors in debt because the value of that debt is just simply beginning to collapse. It's the very early stages of it, but you watch it accelerate. I think over the next coming months, particularly as the Iran situation is not being resolved, Hormuz remains closed. I wouldn't be surprised if the Houthis start kicking off at the bottom end of the Red Sea and closing that one as well. We've got a few hurdles to get over, and they're not nice. They're not nice for the dollar. So why do you think it is that people like the People's Bank of China, various other central banks are buying gold? They're buying gold to get the hell out of the dollar because they know where it's going, because of the thesis that I've just put forward. These guys are smart. They know what they're doing. They know the relationship between money, real money, and the dollar. It's not, as the US Treasury would have us believe, that the dollar has replaced gold. Oh no, not at all.
There's a lot there that I want to talk about, and I know that I look at this from an investment perspective and you look at gold as money. Just walk me through this. When gold falls hard, a lot of investors immediately look at it and question, did I make the wrong trade? Did I time it wrong? Whatever. I know you've always looked at gold differently, but when gold drops 20% after the conflict in Iran kicked off, what was the market telling us? What was going on there? Why did it drop 20%? Everybody just sums it up as people needed liquidity, institutions needed liquidity. What was it?
Well, I mean, it may have been partly that argument, but the other justification for it is the investment approach, and that is that closing the Gulf, the Strait of Hormuz basically means that the energy prices are going to rise. Everything depends on energy prices, so they're going to rise as well. That does mean at the end of the day that higher prices, higher bond yields, that's not good for gold. This is the investment thesis, but it's completely wrong. If you have a stable situation as far as the dollar is concerned, then a situation, let's say, where you can see a little bit of inflation coming along on the horizon, you could argue that there is an investment thesis on that, and that is that there is going to be a greater opportunity cost, if you like, of holding gold, and therefore you should sell gold, buy dollars. I mean, that's basically the story that's been going on since literally the 1980s. But it's no longer true. This is the thing that's fundamentally changed. And I just don't see anyone, particularly people in America, living in America, subject, if you like, to the mainstream media reports in America, brokers' reports, and all the rest of it, not understanding that there is a fundamental change. I'll tell you a few people who do, and that's some of the people at the top of your banking system. I mean, this is why they're saying, well, gold is going to go to, typically, they'll say something like 6,300 or whatever by the end of this year. Why do they say this? I mean, they don't necessarily understand the thesis that I've put forward, that this is actually get out of currency story rather than an investment story. But you can bet your bottom dollar, while it's worth something, that they know people in the top echelons of the central banks who have been selling dollars to buy gold. And they will have gone to them and said, come on, off the record, what's it all about? And they would have discovered what it's about. And that is why, they can, when someone says, senior analyst with that sort of inside information, as it were, understands the implications of what he's been told. He's not going to turn around and say, the dollar is doomed, it's going down to zero, which means that gold is going to infinity, which is actually what he should be saying. No, because if he said that, he'll be dismissed as a lunatic. I can say it. I don't mind being dismissed as a lunatic because I know I'm right. But you can see, if you are actually working in a major bank, you have to make a forecast which is not too upsetting, probably not too far away from what your competitors are saying, and is therefore, as far as Bloomberg is concerned and the rest of them, credible.
You touched on central banks. One of the pillars of this gold bull market has been central bank buying. Recent data showed a burst of central banks selling in March, obviously with the Iran war kicking off. I touched on that. But buying resumed in April. I get what I want to know is this bull market in gold dependent, and I don't even want to call it a bull market with you, rising price environment for gold, or rising value of gold, however you want to put it in dollar terms. Is it dependent on central banks continuing to buy?
Well, first of all, we're looking at a declining dollar, not rising gold. That is the key thing to understand. And so this is where the investment thesis goes horribly wrong. Understand. It's rather, let me give you a parallel. Let's say you're in Germany in 1923, the beginning of 1923. You probably thought prices were rising, and they were rising really quite rapidly. You did not understand that it was actually the purchasing power of your currency, the Reichsmark, collapsing. You probably woke up to that later on that year. It was really from, and if you examine the records, it's really from about May 1923 that people began to realize that it was the currency going down, not prices going up. So, this is a parallel, if you like. We are nowhere near people understanding that it's the dollar going down and not, at this stage, if you like, the feed into prices, commodities going up. No, it's not commodities going up, it's the dollar going down. If you've got the entire commodity complex appearing to rise in value, then it's because the purchasing power of the currency you're measuring it in is going down. And that's exactly where we are. So to answer your question about central banks, it does not require central banks to continue to purchase gold, because we have this dynamic relationship between real money and credit. It's credit that is losing the credibility. Real money just goes sailing along on a fairly even keel. And people just don't wake up to this for a long time. The first people usually to wake up in this situation, what they call high inflation or hyperinflation, which is actually a misnomer because it's loss of purchasing power of the currency. Understand it that way, it just makes so much more sense. The first people to really understand it are foreigners, because they're holding something which they don't have to use. And so they look at it, if you like, subjectively from outside. And they can see what's happening. They make an assessment, what's happening to the bond yields, what sort of position is the issuer of the currency in? In other words, I know it's the Fed, but it's a subsidiary of the US government for all intents and purposes. So, do we want this? And if the answer is no, then they sell it. And you find that the purchasing power of the currency starts declining because relative to gold, it's being sold into the market. People are selling it for gold. Now, The problem we have, actually, is that under normal circumstances, if you had gold standards here, there, and everywhere, people would be selling your currency, which is not on a gold standard, for other currencies which are on a gold standard. But all the other currencies are also fiat currencies, and they look to the dollar, if you like, as a reference point for their value. So where do you go? Well, the answer is you've got to get out of credit. And if you're going to get out of credit, you get into real money or real things. I mean, you get into commodities, for example. You could rush out and buy tons of copper. But that tends to be something which, you need to be in industry to be able to do that, because you've got to have warehouses to store it, et cetera, et cetera, et cetera. So, really, it's the stuff that you use to exchange these things in, which is gold or possibly even silver. Silver, of course, as I said earlier, has got an additional thing, and that is that it is a very, very sought-after metal. And, I mean, we look at prices today. They are really paper prices. I mean, if you look at the open interest on COMEX, it is incredibly low. I mean, the lowest we've seen for 20 years in both gold and silver. And what does that tell us? It tells us that there's very little speculation in there. Therefore, the level of potential selling on this sort of investment scare is actually pretty minimal. So the prices are being marked up and down, really without very much going on. And any industrial user of silver, for example, might say to himself, I'd like to buy some silver at these prices, but where does he get it? Not available. It's just not there. So, and if when you look at gold, again, this is a similar situation as far as the central banks are concerned. They don't go into the market and try and pick it up because it's just not there. They will go to the mines. They might even go to the refiners like Hormuz and Switzerland and so on and so forth. In which case they're told, well, very nice to see you back in the queue. We're a bit busy. So it's a difficult thing. So forget central banks selling this. I mean, apart from anything else, I think that the People's Bank of China picked up something like 9 tons in the last month. I saw that somewhere. And that's, it's been increasing over the recent months, its appetite for gold. Which again basically means that what they're doing is they're selling dollars. They don't want dollars. And not only that, but they told their domestic institutions who hold US Treasury, sell it, get out. They didn't word it quite as bluntly as that, but that's basically what they were saying.
But don't you feel that China's been one of the biggest beneficiaries of the US dollar system?
Yeah, it's used it to its own for its own benefit, certainly. And I guess that quite a lot of its investment abroad has been a way of it disposing of those dollars. But I mean, there comes a time when you don't want the dollars anymore, and that's where they are. So
we focus on, and as you've correctly identified, I look at virtually every asset class from an investment perspective, and gold as well. And I know you've explained the point that it's not an investment, and I understand where you're coming from completely. But I want to, for the everyday investor at home, I want to challenge the gold thesis kind of directly. Since the early 1970s, when you started your career in finance, if you compare gold to the Dow Jones with dividends reinvested, the Dow has actually produced the better compound annual return. So from an investment perspective, if stocks won the last 50 years, why should investors believe gold wins the next 50? Or should they even believe that? Retirement sounds exciting when you feel prepared. But for a lot of people, it creates real anxiety. Will I have enough? What if inflation keeps eating away at my purchasing power? What will my quality of life look like when I'm no longer working? That's why many investors are looking beyond traditional retirement assets and asking whether gold and silver belong in their retirement account. If you're a U.S. investor already thinking about adding gold or silver to an IRA, you need to know what you're actually paying. And that's why we chose to work with iTrust Capital as a paid sponsor of our channel. iTrust Capital gives U.S. investors a way to hold gold and silver plus crypto inside an IRA with no monthly or annual account fees. And transaction fees are shown on the platform, and estimated pricing is displayed before you buy or sell. iTrust Capital reports more than $17 billion in transactions, 300,000 plus accounts, and more than 14,000 reviews rated excellent. Use our partner link in the description to see exactly how iTrust Capital works. If you open and fund an eligible account through that link, you'll get a $100 funding bonus.
Well, it's a non-argument. I mean, I could select a starting date and say, gold has outperformed the Dow, et cetera, et cetera, et cetera.
Yeah, I merely picked the early 70s because Nixon going off the gold standard. Also, coincidentally, when you started your career. So I thought it was a good starting point.
Well, okay. Yeah. Now, let me answer that another way. When you have a proper gold standard, in other words, the currency is exchangeable at the holder's option for gold at a fixed rate, then gold is never, ever spent. It's never used as currency, as, if you like, a means of exchange, or very rarely anyway. Because the whole point about it is it anchors the value of the currency. So you use the currency. So, when you have a proper gold standard, the most stupid thing to do is hold lots of gold. You don't need to. What you're interested in is the deployment of credit, because it's only by deploying credit that you can, if you like, manufacture things, buy things which you rarely need, which you can get some sort of return on, et cetera, et cetera. The point is that credit works for you. Gold doesn't. The only role that gold has is to secure the value of that credit. And if you go back to the 19th century, there was a time when I looked up the numbers on this. The Bank of England, I think for something like 20 years, the level of its obligations, if you like, into the economy, in the form of notes and also bank reserves, hardly changed. Yet, bank credit expanded something like 12 times. And that tells you the difference between money and credit. Credit is something you use. It's there to be used. Banks create it out of thin air if they reckon that your business plan makes sense. So that's the whole point about it. I mean, we're not talking about gold going up. Gold has to have that stability of value. And the fascinating thing is I had a look at Diocletian's edict of maximum prices. And this was going back, I think it was something like 203 AD. So we're talking a long time ago, 1900 years ago. And you looked at some of the prices there. I mean, there are no slave markets, so you don't get different grades of slaves anymore, like women and boys and all the rest of it. But the one thing that you could check was some of the sort of more common things that we have today. I mean, things like clothing, things like beer, things, these sort of things. And it's remarkable how priced in gold they are similar today to when they were then. That's the whole point of it. If you've got a stability, then you can go out and you can do things. It's when you don't have stability. And that actually is what's undermining the situation today. I mean, the whole of the currency situation is becoming incredibly unstable. You really should be just thinking, get the hell out of credit and just get into gold.
So you've broken this down very, very articulately. If you don't consider gold an investment, and you are a big believer in gold, invest? It's money. What do you invest in? If
money.
Not,
you don't invest in money, but basically just get the hell out of credit. It's stop investing. It's a waste of time. It really is. And if you look at equities, relative to bonds, they are in a bigger bubble than they were in the year 2000. Far bigger. I mean, one of the charts I run is I take the S&P I rebase this to, I think it's something like 1980 or 1982, something like that. Take the S&P, and then take the yield on the long bond, reverse the yield on the long bond, again, basing it to the same point back in 1980, 82, whatever. And you should get a correlation, because it's a negative correlation. The higher the yield goes, the worse it is for equities, and vice versa. So there's a negative correlation between the S&P and the yield on the long bond. That's really quite simple. Put them both on a sort of percentage scale or logarithmic scale, if you like, because you're looking at proportions. And indeed, for most of the time, the two track each other relatively closely. But we saw that there was an aberration in the year 2000 when equities went crazy. It would have been a lot more noticeable on NASDAQ, because I think that subsequently fell something like 70%. But that, when that sort of relationship got stretched, it snapped back, and it snapped back with the dot-com bubble going pop. Now, if you look at the situation today, we are 3 times, in fact, more than 3 times, that correlation is more than 3 times stretched than it was in the year 2000. This is the most expensive market, equity market we have seen in the financial era, and possibly even more expensive than in the Roaring 20s in 1926 to 1929. So we know what happens with these bubbles. Now, the reason that the market is there is because there has been an expansion of credit driving equity values. I mean, forget the AI story and this story and that story and all the rest of it. Forget that. Credit has been fueling this market. Just look at the FINRA numbers, which shows broker loans. That has gone up from about 250 billion in 2008-9. Currently, we're looking at over 1.2 trillion. Look at what the hedge funds are doing. The hedge funds have been borrowing from the banks. They don't do broker loans. They go direct to the banks. And they have got, banks and also through the repo market, probably about a further 7 trillion of leverage. Put these two together and just watch that pop. Just imagine what the consequences are. This is not a market you want to be involved with. You don't want any of this credit stuff. You just want to get out and get into gold. It's the only safety at a time of extreme investment danger. I mean, most of the investors punting just don't understand the danger. They don't understand it's credit that drives markets. Fundamentals might make this stock better than that stock on, for whatever. But I mean, when you come to look at the overall market level, it is credit driving it directly and indirectly. Now, if that's going to take a bath, you know where the equities are going. You will find that the banks have got all that collateral. What do they do with it when the market starts going down? They do what they did in 1929 to 32. They sell the collateral because they want to secure the value of their loans. They want to secure that. They don't want to have losses, if you like. As Irving Fisher worked out, this was one of the things that really drove the market down in 1931-32. Banks liquidating equity positions, nothing to do with the value of the companies. It was they had this problem, but the banks have already got these problems. Look at the private equity side, look at the private finance side, look at the industrial property side, offices and so on and so forth. The banks can see some problems here, and they're not far off turning around and thinking, we got to start liquidating things. I mean, the trigger will be an initial fall in equities. Of course it will. But just watch it happen. I mean, these are very dangerous times, Aaron. They really are. And investors don't understand it. They really don't. And brokers won't tell them because they're in the business of getting investors to buy stocks.
See, I think many investors do understand it, but they're forced further down the risk curve with inflation being so stubborn and the lack of opportunity to go out and start a new business in brick and mortar space if you're industrious enough to try it. I think people are being forced into taking risk to maintain their quality of life. So they say, you know what, I know it's risky, but this is the financialization of the economy now. This is the opportunity. And I think that's what they see. Now, I'm not saying that it's not dangerous, but basically what you're saying is super highly levered market. People are borrowing money to invest. It's going to set up for a crash. And what you're also saying is basically, I'm inferring this, so correct me if I'm wrong. You, Alasdair, have your earnings, your extra earnings that you don't need to live off of, go straight into gold. Is that basically, that's the whole strategy?
I'm getting out of credit. I earn credit, yes. I mean, in my case, sterling, and I just get the hell out of it as soon as I can. I mean, obviously, I still spend a bit of money going to the odd restaurant and all that sort of stuff, and putting gas in the car. But
beyond lifestyle, though, you don't have any desire to invest in equities. Or when's the last time you bought a stock?
I can't remember.
Wow.
I think the last bit I sold stock, which I had as a result of sort of share options and things. But I don't think I've actually been in buying stocks. Well, I bought a silver mine, actually. That's true. I did buy into a silver mine. And that went up from, initially it went down. I think I paid about £5 a share, went down to £3, and it's now 32 or something, £32.
A lot of people say scared money doesn't make any money, right? And if you're just putting all your excess capital into gold, that seems like a pretty scared move. Now, I get the macro picture.
Well, hold on. Yeah, define money. That's the first thing.
Exactly. That's the problem. Is I look at it as from an investor's perspective, and you from a money perspective. I want to know one more thing, because this is what kind of concerns me about precious metals, even though I've been holding for a long, long time, and the related mining equities and so forth. I'm heavily allocated in the precious metal space. Yeah. How did you feel from 2013 to 2020, call it 2021-ish, when gold was effectively dead money and the markets were ripping? Did you not question what you were doing?
Yeah. Well, it was worse than dead money between 2011-12 and 2016, because it went down from a high of 1920 down to, I think, 1,048. I seem to remember was the number.
Yeah, good memory.
I mean, the answer basically was I just accumulated, and that was the thing to do. I knew where this was going. I just didn't know how long it would take. We still don't know how long it'll take. We really don't know. I mean, we might wake up tomorrow morning and find the whole world has gone, base over apex. But the answer basically is that you accumulate savings if you're wise. Yeah, and what you do with those savings really becomes very, very important. And the way I looked at it was quite simple. I knew where this was going. I didn't know how long. I hoped we had lots of time to continue to accumulate gold. I didn't give a damn about the price. The price is completely irrelevant. All I was looking at was securing, if you like, my savings for the longer term, which basically meant getting out of credit at every opportunity. And I mean, there were periods, obviously, when it didn't make sense, if you like, from an investment point of view, to go and buy gold. I mean, you look at the chart and you see it was going down. But on the other hand, if you want to accumulate something, you just don't become price sensitive. You just go ahead, continue doing it. And that's what I did. And it served me extremely well. When you get the Federal Bank of New York refusing to return the Bundesbank's gold, and eventually agreeing to return a small portion of it and taking 7 years to do it, you begin to ask yourself, what have they been doing with that gold? And I think you might find that something like, well, Frank Van Rosa's estimates, if you like, of between 10 and 14,000 tons of gold had been leased into the market. And I think he put it in somewhere that it ended up adorning the necks of Asian women. No, it didn't. What actually happened is that it was bought by China. China very carefully accumulated it. So we have a situation now. I mean, even if you look at the holdings of the individuals from 2002, something like 28,000, 29,000 tons of gold has been driven into individuals' hands, most of it jewelry, obviously. So I would think, I mean, China has been like Hotel California for gold. Gold goes in, but never comes out. It's been like that, really, since the 1980s. And that 20,000 ton figure, I don't know, could be 30,000 by now, quite easily, in the government. I mean, the point is that they can back their currency. And then when you see last year, the Shanghai Gold Exchange opening vaults in Hong Kong and Saudi Arabia. Saudi Arabia, obviously, because quite a lot of oil goes from that region to China. You can see that. I mean, and the thing about those vaults is that you could move gold in and out, but only with Chinese yuan, no other currency. So you could see that actually the mechanism is in place for China to put the yuan on a gold standard. It just needs to announce the rate. It's not going to do that too early for the very simple, not because it's trying to maximize the benefit or whatever. No, not at all. They're smarter than that. The reason that they haven't done it yet is because they don't want to be blamed for destabilizing the global economy. Because if they did that, then I think a lot more people would actually understand my argument. Get the hell out of credit and get into gold. Because, America ain't got what she says. That I'm absolutely convinced. Not only that, but she's raided other countries' gold, which was entrusted with her. That was obvious from the, from the Bundesbank's sad thing, and also obvious from the Bank of France, who really pulled a blinder. I mean, we don't know what the negotiations were under, which before this happened, but basically what the Bank of France did is they turned around to the New York Fed and said, right, okay, if you can't deliver the gold, then I tell you what, we'll sell it to you for dollars, which they did. And the market timing was absolutely brilliant. So they say. I mean, we don't know. We don't know really for certain. And they went and bought it from elsewhere. Now, they got a lot of gold. They must have, they must have picked up secret gold from here, there, everywhere. But they say that they got it all back. Now, if they managed to do that, I mean, what a good blinder. You can't deliver the gold. Okay, give us the dollar equivalent. We'll run in the market and buy it. It's brilliant.
Interesting.
Brilliant. Yeah.
So, last question. I'm 43 years old in a couple of days here. You think the best strategy, let's say I'm building a strategy for the next, 20, 25 years before I want to kick up my heels and relax as a older fella. God willing, I make it to 80 or 85 years old. You think the best play is, why not just invest in gold effectively through my earning years so I can kick back and relax and just
There's
ignore
that word again, investing in gold. No,
yes, I know it's the wrong goal. It's the wrong word, but allocate my capital into gold as opposed to, say, a diversified portfolio.
Get into gold. And it's a two-stage thing. Once the currencies have gone, lost their value completely, you'll be able to buy things with your gold. I'll give you an example. In 1923, going back to Germany, hyperinflation, which basically means collapse of the purchasing power of the Reichsmark. In late in that year, you could have bought a 6-bedroomed house in a swanky part of Berlin for less than 5 ounces of gold. I mean, we're talking $100 because it was on 20.67 at the time. That's what happens. The inflation kings were buying estates, landed estates. I mean, you could buy a 25,000 estate, whatever, for virtually nothing. And because everybody who hadn't got into gold was basically impoverished by the collapse of the purchasing power of the currency. That's what happens. So the answer to your question is that if you play this right, get the hell out of credit, get into gold, you will have some wonderful opportunities when the dollar goes down towards zero to pick up this, that, and the other thing. The things that you would dream of owning. Country, state, ranch, whatever. Perhaps you don't dream about having that.
I'd love to have a ranch. I'd love to have a ranch and some horses. That sounds great.
Absolutely. So, play your cards right, you'll get it. And so it's a two-stage thing. The first thing is protect yourself from the coming collapse in the value of credit. And when it collapses, then you'll have all these things that you can pick up. I have to say, it's not going to be a nice process going through this, because lots of people are going to starve, and particularly people who live in cities. It's going to be terrible. And of course, the effect on society, it's just destabilizing the whole thing. I mean, you're going to have, gangs running around hungry, thieving, robbing, killing people for whatever. It's a horrid outlook. But you need to protect yourself in a way in which you can get through it. And you need to also think about, your family and all the rest of it. Make sure you've got enough to keep them going, and those who are close to you in your community.
How far out do you think something like that might be? Are we talking 5 years, 10 years, 20 years? What do you think?
Could be this year, for all I know. I mean, if the financial system falls apart on this, which is quite likely, when you start seeing the equity bubble really implode, which it will as soon as you get the long bond yield or the 10-year going up through 5% and looking, oh my God, it's going higher and higher and higher, sort of thing. I mean, that could be a matter of even a month or two, and that would start the process.
This has been a very enlightening conversation, so I thank you for that. Where can our viewers find you online and learn more about your thoughts and analysis?
Well, I run my own Substack, which is macleodfinance.com. That will take you there. MACLEOD finance.com. And, I mean, the value to me of this sort of interview, Aaron, is trying to get as many people as possible to understand what's going on for their own protection. So I try and express this, as well as obviously following markets, because, people want to know what to do in this market or that market. But I'd never make investment recommendations. But what I do is try and educate people about what is actually happening, the difference between money and credit, and the risks involved if you're in credit, and the right way to look at that relationship and everything that flows from it.
Well, I think you've done a fantastic job of that, Alasdair. I want to thank you again for your time, and I hope to have you back on before the year's out.
It's very much my pleasure. Thank you for having me on.